Welcome to a new deep dive. Today we're plunging into a fascinating topic, one that touches nearly everyone's daily life. The enduring business quality of the Procter & Gamble Company, P&G as most people know it.
That's right.
We've got this incredibly detailed investment memorandum here, dated June 28, 2025, from an Office of the Principal. It's analyzing P&G as the potential multi-decade core holding.
Yeah.
So yeah, a real deep dive into something pretty fundamental.
Absolutely. And our mission today really is to unpack whether P&G actually qualifies as what, Warren Buffett might call a wonderful company.
Right.
Something you could buy at a fair price and, hold for a very, very long time. We'll be digging into the durability of its business model, its competitive advantages, its moat, the quality of management, and its financial resilience.
So basically, is P&G as solid as its brands suggest?
Yeah.
Is the business as dependable as, say, Tide or Pampers?
Exactly the question.
Okay, so let's kick things off by understanding the very foundation here, P&G's business. On the surface, it seems almost deceptively simple. What exactly is it they do that makes them so, ubiquitous?
Well, at its heart, P&G develops, manufactures, and sells branded consumer packaged goods, CPGs. And you have to think about it. These are products billions of people use every single day, often without even a second thought.
Right, just habit.
Totally. Hygiene, cleaning, personal care. They operate across 5 main segments: beauty, grooming, healthcare, fabric and home care, and baby, feminine, and family care. The key insight, though, is their revenue isn't from one-off buys. It's from high-volume, high-frequency, habitual purchases.
The repeat business.
Exactly. Across over 180 countries through this vast network of stores and, increasingly, e-commerce, too.
So it really boils down to essential, almost non-negotiable needs then. You're not talking about discretionary items like luxuries.
Precisely. We're talking Pampers diapers, Charmin toilet paper, Tide laundry detergent, Gillette razors, Crest toothpaste. These aren't just wants. They're fundamental solutions to daily problems, deeply ingrained in modern life.
Things you just need.
Yeah. The underlying need for clean clothes or oral hygiene, for instance, it isn't going to be threatened by the next big tech gadget. And that makes this business model exceptionally enduring. The demand is just fundamentally stable.
Okay, here's where it gets really interesting for me. How do they defend that? How do they defend their turf? The memo talks about an economic moat. Maybe just quickly, for listeners, that's basically a sustainable competitive advantage, right?
That's it, exactly.
So how does P&G build and maintain that commercial fortress?
P&G's fortress, it has 2 primary interlocking moats. First, intangible assets, and second, cost advantages.
Okay.
Their most formidable advantage, it's that portfolio of iconic, trusted brands. Tide, Pampers, Gillette, Crest, Olay. Many built over, 185 years now? This brand equity, it creates incredible mental shortcuts for shoppers. You see Tide, you just know it cleans. That fosters multi-generational loyalty, and crucially, it gives P&G significant pricing power.
Because people will pay for trust.
They will. They'll pay more for a brand they trust completely.
And the cost advantages. How does their sheer size play into this?
Oh, their colossal scale translates into immense advantages. Think about it. In annual advertising budget over $8 billion.
$8 billion?
Yeah. That buys a pervasive media presence that smaller rivals simply can't match. Imagine trying to launch a new detergent and outspend Tide. It's almost impossible.
Right.
Then there's R&D, about $2 billion a year. That lets them outinvest competitors in product science, innovation, leading to things like Tide Pods or the Oral-B IO toothbrush. These aren't just tiny tweaks. They can redefine categories.
Mm-hmm.
And finally, their global supply chain, spanning 180 countries. That gives them enormous purchasing power and huge leverage with retailers, ensuring they get that prime shelf space.
To really bring this to life, the memo uses Tide detergent as a prime example. What does Tide tell us about P&G's moat in action?
Yeah, Tide's a perfect illustration of this dual moat. It commands a dominant 35.4% share of the U.S. laundry detergent market.
That's huge.
It is. And the intangible asset is immense. Tide isn't just a product. It's basically synonymous with effective cleaning, with reliability. This deep trust lets them consistently price Tide at a significant premium. And P&G relentlessly advertises it, innovates with new tiers like Tide Pods, making sure it stays ahead. That combination, massive brand building plus scaled R&D, it makes it nearly impossible for a new entrant to compete. They just can't match the trust or the investment.
So the moat sounds incredibly stable, almost impenetrable. But, the competitive landscape is always evolving. What are the new challenges P&G is facing? How are they adapting their defense?
That's a great point. While the core moat is stable, they still hold dominant market shares, like 60% in global grooming. The nature of the siege, as you might say, is changing.
Okay.
We're seeing the rise of private label brands from major retailers. Think store brands. They compete aggressively on price.
Right, the cheaper option.
Exactly. And P&G's defense here is pretty straightforward. Aim for noticeably superior products. The idea is, if their product genuinely cleans better, smells better, lasts longer, consumers will often still pay that premium.
Makes sense. And what about the direct-to-consumer disruption? DTC, we've seen that shake up so many industries. How has that played out for P&G?
Yes. The men's grooming category is a really stark case study there. You had brands like Dollar Shave Club, Harry's. They completely bypassed P&G's traditional retail muscle and advertising advantages.
They went straight to the consumer online.
Right, with subscription models. And this definitely contributed to Gillette's U.S. market share falling. It went from about 71% in 2010 down to 54% by 2016.
It's a big drop.
It is. P&G's response, and this is key, has been to make the product itself the primary defense, focusing on what they call irresistible superiority.
So performance again.
Performance and innovation. The core message here, I think, is that the moat's trajectory now depends less on just outspending everyone and more on P&G's rate of meaningful innovation versus how quickly competitors can disrupt the business model. It's really become an innovation arms race.
Fascinating. Okay, so we've looked at P&G's external defenses, its brands, its scale, financial strength. But a company's true resilience also comes from its internal vitality, right? What its customers and employees really think. Let's shift gears and get into that scuttlebutt, that kind of qualitative intel from the ground up. First, what's the sentiment around P&G's products from the customer's view?
Yeah, the scuttlebutt reveals the central tension. Superior performance versus that premium price. Take Tide again. Reviews consistently praise its cleaning power. People call it #1, say it tackles dirt, sweat, and stains effortlessly.
Okay, that's good.
But crucially, users often frame the price like a little costly, but worth the price. And that absolutely validates P&G's superiority strategy. People are willing to pay for that performance they trust.
That's great for Tide. But what about other big brands like Pampers and Gillette? They face pretty different market dynamics, don't they? How does customer sentiment reflect their positioning?
Right. Pampers shows, well, a more mixed picture. Many loyal users still praise the comfort, the absorbency, but there's this concerning trend, apparently, of recent complaints about a perceived decline in quality.
Oh, really?
Yeah. Users feeling expensive diapers are not working like they used to. Now, that's a potential red flag for brand equity erosion because it directly challenges that superiority claim.
Definitely something to watch. And Gillette.
For Gillette, premium products like their heated razor get absolutely glowing reviews, which shows innovation can still command a premium price. But the high cost of replacement cartridges is this consistent drawback you hear again and again. It indicates ongoing price sensitivity from consumers, even for a known brand.
Okay. Are there any absolute home runs in customer love where P&G is just crushing it?
Oh, absolutely. The Olay Regenerist line. It's overwhelmingly positive. You see tons of users saying it performs as well as, or even better than, prestige department store creams that cost hundreds more.
Wow.
It really demonstrates P&G's ability to deliver that premium performance, but at a masstige price point, that sweet spot between mass market and prestige, kind of an affordable indulgence. It's a fantastic example of their strategy working really well.
Gotcha. Now let's flip the coin, the internal view.
Yeah.
What's the employee perspective on P&G's culture? What are people working there actually saying?
Employer reviews, well, they paint a picture of a very demanding, high-performance, and deeply data-driven culture. It's often described as the P&G way.
The P&G way.
Yeah. Some even call it a cult-like mentality or a hustle culture where results, and maybe perception too, are paramount. It sounds pretty intense.
Intense. Is that actually a good thing for the business in the long run? That kind of pressure?
From a long-term investor standpoint, the memo argues it's a net positive. Yes. P&G is consistently praised for its world-class training programs, a strong promote-from-within philosophy, excellent compensation, and really high-caliber peers.
So good people, good training.
Right. Data from Great Place to Work shows 71% of employees consider it a great place to work, which is significantly higher than the 57% average for typical U.S. companies. Now, it can be bureaucratic, maybe slow to change, and lead to poor work-life balance for some, no doubt.
I can imagine.
But this intense, data-driven, high accountability environment directly drives that relentless focus on product superiority and market share gain, which is critical for defending their competitive fortress, right? It attracts and retains highly driven individuals who are committed to that mission.
Okay, that makes sense. So we've established P&G's strong business model, its competitive advantages, even dipped into how customers and employees see them. Now we need to talk about the people steering the ship. Who's leading P&G, and what's their management philosophy like?
The current chairman, president, and CEO is John R. Moeller. He's a P&G veteran, been there since 1988. He became CEO in November 2021 after a long and, frankly, very impactful tenure as the chief financial officer, the CFO.
Ah, so he knows the numbers inside out.
Definitely. And his philosophy seems very owner-oriented. There's a clear commitment to balance top and bottom line growth, a focus on expanding the total market through innovation rather than just stealing market share from competitors, and making the consumer the absolute North Star for all decisions.
Sounds very clear-headed.
Yes, and very focused on long-term value creation.
He sounds incredibly disciplined. The memo highlights his role in rational portfolio management. In an era where, some companies are just buying growth aggressively, what does this rational approach tell us about Moeller's bet on P&G's core strengths? What did that involve?
Well, as CFO and later COO, Moeller was absolutely key to P&G's massive portfolio transformation. They divested over 100 slower growth brands.
100. Wow.
Yeah, big names too, like Duracell batteries and Pringles snacks. This wasn't just minor tidying up. It shows a really clear, rational approach, a willingness to avoid that empire-building trap that can actually destroy shareholder value.
So pruning the portfolio to focus.
Exactly. They shed businesses that didn't really fit that superiority model, focusing resources instead on where they could truly win and generate higher returns.
Okay, so with all that focused effort, how does P&G deploy its enormous cash flows? Where does all that money actually go?
Their capital allocation seems like a model of rationality and shareholder friendliness. First, they reinvest significantly back into the core business, consistently spending about $2 billion a year on R&D to drive that innovation we talked about.
Like the lifeblood.
And about 4 or 5% of net sales on capital expenditures, CapEx, to maintain their global manufacturing excellence. Keep the factories top-notch. Second, M&A activity, mergers and acquisitions, it's minimal and highly strategic.
Not buying big companies then.
No, mostly focused on small, tuck-in acquisitions. Things like native deodorant or Meow Organics brands that fit neatly into their existing categories and can really benefit from P&G's scale and distribution power.
Okay. And then what's left over for the shareholders, for the owners of the business?
That is a massive priority for them. I mean, just look at fiscal year 2024. P&G returned over $14 billion to shareholders.
$14 billion.
Yep. That was made up of over $9 billion in dividends and about $5 billion in share repurchases or buybacks. And get this. In April 2024, P&G announced its 68th consecutive annual dividend increase.
68 years in a row.
68 consecutive years. That's a truly remarkable record of consistency and commitment. It highlights the business's durability and management's clear dedication to its owners.
That's incredible. Just pure consistency. This naturally leads us to the financial fortress aspect.
Yeah.
Beyond those impressive cash returns, what do the core numbers, the metrics, tell us about P&G's financial health?
Well, P&G is truly a highly reliable earnings machine. They've achieved 6 consecutive years of 4% or better organic sales growth, and their core earnings per share grew 12% in fiscal 24. That shows incredible resilience, even amidst all the recent inflation.
Yeah, that's strong performance.
And their gross profit margins are robust, nearly 52%. Operating margins consistently in the low to mid 20% range. These aren't just good numbers, they really speak to exceptional efficiency and significant pricing power.
Can you give us maybe a couple of key quality ratios that really underscore that financial strength?
Absolutely. Their return on invested capital, ROIC, which basically tells you how efficiently they're generating profits from the capital they've put into the business, is consistently in the high teens, like 17.2% to 17.6% over the last few years. That's a clear sign of a world-class operation.
Very strong.
And their free cash flow conversion is exceptional, consistently at or even above 100%. That means they convert pretty much all their accounting profits into actual cold, hard cash, which is crucial for funding those dividends and buybacks we just talked about.
Right, cash is king.
It is. And finally, their net debt to EBITDA ratio is exceptionally low, hovering around just 1.0x. That signifies a fortress-like balance sheet with really minimal leverage risk. So yeah, the overall picture is one of exceptional profitability, fantastic cash generation, and just rock-solid financial strength.
So, okay, we've pretty clearly established P&G as a high-quality business, great management, strong financials. But as any seasoned investor knows, a wonderful company isn't always a wonderful investment if the price isn't right. What's the valuation look like today? Are we paying too much for this quality?
That's the million-dollar question, isn't it? As of late June 2025, P&G trades at a price-to-earnings ratio, PE, of about 25.3x, and a price-to-free cash flow, PFCF, ratio of about 24.8x.
Okay, how does that compare?
Well, when we compare this to its own 5-year average PE, which is around 25.5x, it's right in line. And compared to the broader consumer staples sector, which averages around 21.8x PE, P&G trades at a slight premium.
A premium. Is that premium justified in your view, given everything we've discussed about its quality and moat?
Yes, the memo's crucial judgment, and I tend to agree, is that it is justified. That premium reflects P&G's superior profitability, its higher ROIC, its undisputed market leadership. The memo concludes the current market price represents a fair entry point for a long-term owner.
So not cheap, but fair.
Exactly. It's not a bargain bin stock, but it's not demanding some crazy speculative valuation either. You're effectively paying a fair price for an exceptional, predictable business that has proven its resilience over, well, many decades.
Okay. So if it's fairly valued, growth becomes important. It's not necessarily about rapid growth, maybe, but quality growth. Where will P&G's future earnings actually come from looking ahead?
The primary growth engine they talk about is premiumization fueled by innovation, primarily within emerging markets. Let me break that down.
Please do.
In mature markets like North America and Europe, growth comes more from persuading existing customers to upgrade, moving them to higher-priced, higher-margin products. Think moving from basic Tide liquid to those higher-margin Tide Pods.
Gotcha. Selling better stuff to the same people.
Right. But the larger volume growth opportunity really lies in emerging markets, places like Latin America, India, parts of Asia, and Africa. There, rising incomes allow consumers to trade up from local, maybe unbranded alternative to P&G's trusted high-performance brands for the first time.
So new customers in growing economies.
Exactly. That's where the bigger volume potential is.
Okay. Now, every business, no matter how strong it seems, faces risks. What are the big permanent impairment risks for P&G that the memo flags? The things that could really hurt it long term.
Right. No investment is risk-free. The memo highlights three main ones. First, and arguably the most significant, is systemic brand erosion and commoditization.
Meaning the brands lose their magic.
Kind of. If P&G's innovation pace fails to keep up with private label and those nimble DTC competitors, and crucially, if consumers no longer feel that performance gap justifies the price premium, well then their whole high margin model would be permanently impaired.
And those negative Pampers reviews we talked about.
Exactly. That's a potential micro example of this creeping risk. If that becomes widespread across brands, it's a huge problem.
Okay, what are the other two critical risks?
Second is failure to adapt to channel shift. We touched on this. P&G's scale advantages are strongest in traditional brick-and-mortar retail, commanding that shelf space.
Right.
While their e-commerce sales are growing up 9% in FY24 to 18% of total sales, some analysts suggest they aren't winning online quite as decisively as they do in physical retail. If consumer discovery and buying habits permanently shift away from physical shelves to online social commerce, they could risk losing the next generation of consumers.
A big structural shift.
Potentially. And third is structural, geopolitical, and supply chain disruption. Think about a permanent reordering of global trade, sustained extreme commodity inflation they can't pass on, or major political instability in key emerging markets. Any of those could structurally impair margins or growth if they can't manage through it.
Okay, those are definitely serious long-term considerations. So, stepping back a bit, what's the general market consensus on P&G stock? How do most analysts and investors tend to view it?
Yeah, the prevailing market narrative, the common story, is that P&G is a high-quality, stable, but ultimately low-growth defensive stock. You know, a safe haven when things get choppy, but not particularly exciting.
The sleep well at night stock.
Kind of. The consensus analyst rating is typically a moderate buy, usually with pretty modest single-digit upside predicted. The bear case tends to focus on decelerating organic growth maybe, or those macroeconomic challenges, while the bull case points to continued market share gains, those productivity improvements cutting costs, and steady innovation.
So, knowing that consensus view, what's the contrarian angle then? How does our deep dive maybe challenge this commonly held perception of P&G as just a stable, slow grower?
Well, our analysis and the memo's conclusion suggests the market might be underestimating the durability and the compounding power of P&G's focused, superiority-driven growth model.
Underestimating it. How so?
The market tends to focus very narrowly on that low to mid single-digit organic sales growth guidance number, but it often misses the quality of that growth. By relentlessly prioritizing irresistible superiority, P&G isn't just selling more units, they're driving premiumization. They're actually expanding gross margins, even in tough inflationary environments.
So it's not simply about the top-line number itself, but how that number is achieved, the profitability of the growth.
Exactly. It's high-quality revenue growth. And then that growth is amplified by massive productivity programs, generating hundreds of millions in cost savings every year. This results in a highly efficient profit engine that converts an exceptional amount of earnings into free cash flow.
Which then fuels the dividends and buybacks.
Precisely. That cash fuels one of the most powerful capital return programs globally, driving per-share value growth even when that top-line growth looks, frankly, a bit pedestrian. So the market might see a bond proxy, something safe but dull. But our analysis reveals a really rational, disciplined compounding machine. It's a quiet compounder, perhaps, not a flashy growth stock.
Okay, let's try to bring this all together then. Let's look at the summary bull case and the bear case for P&G. For someone considering owning this for the long haul, what are the core reasons to be optimistic? The bull case.
Right. The bull case rests on a few key pillars. First, indestructible demand and intelligible model. These are essential products serving timeless human needs. Everyone needs to clean things, maintain hygiene. Simple to understand. Second, fortress moat, built on brands and scale. You've got those iconic brands like Tide, Gillette, Pampers, reinforced by absolutely unrivaled advertising spend, R&D investment, and global distribution scale. It's incredibly difficult for anyone else to replicate that. Third, disciplined, owner-oriented management. Leadership like John Moeller, clearly committed to rational capital allocation, prioritizing high-return internal investments and those massive shareholder returns through dividends and buybacks. And fourth, financial powerhouse. Just elite profitability with high ROIC, excellent cash conversion turning profits into cash, and a fortress balance sheet with very little debt.
Okay, a very strong bull case. Now, for the balanced view, what's the counter thesis? The reasons not to own it, or at least the major risks to that bull case. The bear argument.
The bear case challenges those strengths. First, brand relevance under siege. The threat from private label and those nimble DTC competitors chipping away, potentially eroding pricing power and leading to commoditization if P&G loses that superiority edge. Second, the innovator's dilemma. The risk that a giant established company like P&G may be too slow to adapt to fundamental shifts in retail channels, especially things like e-commerce and social commerce, thereby ceding future growth to newer players. Third, mature markets and slow growth. Its heavy dependence on slow-growing mature markets like North America and Europe might not ultimately justify its premium valuation, especially if emerging market growth doesn't significantly accelerate. And fourth, valuation offers no margin of safety. That fair price we talked about means there's not much cushion. Any significant missteps, any slowdown in executing that superiority strategy could lead to poor returns because you didn't buy it at a discount.
Right. Paying a fair price means you need things to go mostly right. Now, to rigorously test our own deep dive, the memo includes something called a red team challenge, where you basically invert the bull case.
Right.
What if our central premise that P&G's moat is stable and even widening is just fundamentally wrong? This feels like the critical stress test.
It really is. And this is probably the most compelling argument for how a long-term investment could fail. The question is, what if that whole superiority strategy is actually a costly, maybe even futile defense against a moat that has been permanently breached?
So the walls are already crumbling, maybe.
Potentially. In that scenario, the Gillette DTC story wasn't some isolated incident. It's the actual blueprint for the future across their categories. The argument goes, the internet has democratized distribution and information, making consumers more price-sensitive, less automatically brand loyal. In that world, P&G's billions spent on R&D and advertising face diminishing returns. They end up on what's called a Red Queen's treadmill, from Alice in Wonderland, running faster and faster just to stay in the same place, never truly getting ahead in terms of market share or pricing power.
Just maintaining at huge cost.
Right. Their iconic brands slowly lose that premium pricing power. They become ex-growth assets, and those lovely high margins get competed away by cheaper alternatives. The elite return on invested capital, that hallmark of P&G's greatness, inevitably reverts down towards the industry average.
And the stock?
In that grim scenario, the stock would almost certainly derate. It goes from being valued as a wonderful company to being valued as, well, frankly, a melting ice cube. And that would result in a significant permanent loss of capital for an investor buying at today's fair price.
Wow. That really lays out the downside risk clearly. This whole deep dive into P&G, it really makes you think about the power, but also maybe the fragility of brands and scale in this rapidly changing world. It's a reminder that even the most established giants face just relentless pressure to innovate and adapt.
Mm-hmm.
What stands out to you as the biggest, maybe the most lingering question that this deep dive leaves us with?
That's a great question. For me, it raises a really important point that extends far beyond just P&G. It's this. In a world of, increasing transparency, seemingly infinite choice online, and constant disruption, can even the most iconic, historically dominant brands truly maintain their irresistible superiority and the premium pricing that goes with it? Or are we inevitably heading into an era where good enough at a lower price will almost always win out in the end? It's definitely something for you, the listener, to consider as you go about your day. Perhaps the next time you reach for one of those daily use products on the shelf or in your online cart.